We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. This is a pre-recording of a Twitter Spaces live event that we hosted last week. If you'd like to be a part of the next one, go on to Twitter/Palisades Radio, and you can be part of the conversation. You can listen to our conversation on the desktop, but it works better on the mobile app because then you can actually log in and ask us questions and interact with us as well. Just as a reminder, as always, you can find our podcast on Spotify, Apple Podcasts, and anywhere you want to listen to it, as well as Odysee if you don't enjoy using YouTube. I hope you enjoy it and hope to see you on the next one.
Good morning or afternoon, everyone. Welcome to the space for today. Thanks for tuning in.
Hi, Doomberg here. Can you hear me?
Yep, sounds good, Doomberg.
Perfect.
Hello, everyone.
How are you this morning, Steve? I know it's early for you. It's pretty crazy that we have so many different time zones here today. Francis is, I believe it's 8 p.m. for him, and it's 7 a.m. for you, right, Steve?
Yes. Yeah, we are about 12 hours apart. And then I guess Doomberg is right there in the middle somewhere.
Yeah, we're in Eastern time zone here.
Hey, Tom.
Hey, Bob. How are you?
Good.
Thanks for joining us too. We're just waiting for Francis to join as a speaker too, but he's in here. So, obviously, Doomberg and Steve, you guys talk a lot about energy, so I'm sure we're going to spend a good amount of time on that, and then maybe we can have Francis kind of fill in some of the other, let's say, the other fundamental or macro stuff. But is there anything that you guys wanted to particularly start with that's on your minds of late?
It depends. If Doomberg, you want to go first, but it's a pleasure finally getting to, chat alongside with these guys. I think this is a great forum to do it. And yeah, it's funny. I'll just start off by saying I got into precious metals for all the same reasons most people do. And that's the problem with the debt and the money printing and the devaluation of currency, especially the dollar. But then I found out that it was really energy is the driver of the economy. And so as my analysis started to focus more on energy, it was important. So I started talking more about energy to my subscribers and followers. And, they just, Steve, let's just talk about precious metals. We don't care about energy. Well, the energy cliff dynamics I've been kind of warning about now has finally hit. And so now people who are ignoring energy have to really pay attention to it because it is the number one driver of the economy. And so I think that's a good way to start this. It always starts with the energy first. And even money, which is gold and silver and paper money, all are a derivative. And even the economy and financial assets are derivative of what happens with energy. So once we understand that fundamental principle, everything seems to fit, or everything seems to, we have an idea of where we're going to go forward.
Yeah, I would just add, sitting here contemplating how we got here in energy has been a key theme of our writing since we started Doomberg 13 months ago. And our good friend Tony Greer over at TT Macro has been preaching about the Great Rotation. And what does the Great Rotation really mean? It means that for the first time in a long time, we're at a point of energy scarcity. And so energy is indeed life. But the fact that energy is life isn't apparent until there's a lack of energy. And then we have to contemplate how it is that we distribute life. When you are in a period where there's excess primary energy production, and the price of those inputs that drive the rest of the economy are reasonable compared to historical ranges, it's quite easy to forget that energy drives the entire bus. And so now that we've had this sustained period of a combination of defund the financial investment into the energy sector movement, combined with admittedly substantial amounts of value destruction in the shale paths from a shareholder perspective, which has led to a period of unwillingness to invest and to monetize existing assets so that shareholders can be remunerated. And then you can layer on top of all of that the supply chain consequences of our reaction to the pandemic. You have this perfect storm of extreme shortages of energy during a period in which the world economies were rebounding. And ultimately, since energy is life, the price elasticity demand of life is high. And here we are. We're sitting here today with, oil WTI at $120 a barrel and natural gas almost back to $9 per million BTU in the US and $25 to $30 per million BTU in Europe and in Asia. Coal, at local record high costs. It's become apparent during shortages. You can't test elasticities until they're short, and we're running a full test on the price elasticity of demand.
Doomberg, something I was thinking about yesterday is, and I wonder if you can speak to this, is what is the forward date price for oil? I mean, I spoke to somebody recently, and I can't remember who it was, that said there was some of the futures contracts for oil were priced at something like $300 a barrel.
No, that's not true. Let me just pull up the. Now they could have been talking about natural gas. So if I pull up the futures curve, it's actually pretty front loaded, and if you go out to say 2025 or 2026, you're back below $70 a barrel. I'm talking WTI, not Brent here. And so it is, and the reason why that is because you can't persist. The demand will be destroyed. And so the big question right now is, and this is what traders are trying to figure out and what investors are trying to figure out, is at what point does demand get destroyed? And ultimately, you can't, since energy is life, if you're not producing energy, you have your standard of living is defined by how much energy you get to waste. And so that's going to be distributed unevenly. And there's going to be a clearing price where the wealthy in the world are going to demand their unfair share of the energy. And that's going to put a lot of people in a hard place. But ultimately, the cycle will turn. So the question is, does that cycle turn at 120? Does that cycle turn at 200? Or does that cycle turn at a price level we wrote about last June in 2021, when WTI was in the 60s? We wrote a piece called Oil to 300, ? Do we need that kind of a supernova blow off top to truly destroy demand and tip the economy into a severe recession/depression? That's how this will end. It has to be how this will end, because you can look at the capital being deployed and you could look at the timing of the projects coming online, and you could marry that up against unfettered demand at current prices, and you will find that there's not enough energy to go around. And so we've not yet found that clearing price. The canary in the coal mine for us that we've been watching lately, and many people have pointed it out as well, is this the 3-to-1 crack spread, which is a rule of thumb measure for how profitable refiners are. And that's blowing out to, almost $60 a barrel right now, which means that the refiners who are providing the diesel and the gasoline, the distillates, distilled products out of the refinery, they could pay a lot more for oil today and still enjoy historically significantly elevated margins. And so until that number drops back to the historical range of 10 to 15 or $20 a barrel, there's a sort of steady bid under energy. And so we shall see. I think that the administration's behavior in this regard reflects a lack of fundamental understanding of physics, and it reflects a lack of an understanding of how the economy works. And that's in some ways understandable because we had so many years of excess primary energy production, and we could be forgiven for assuming that energy is just another commodity, and energy is in fact, the primary commodity, and currencies are in fact a derivative of energy. And that's what we're seeing today. I had a nice exchange with Brett Johnson on Twitter a couple of days ago. The countries that are net energy and grain and calorie exporters, their currencies on a relative basis are doing extremely well. Those countries like Japan and Korea and the euro and the British pound, where they have severe energy shortages, their currencies are struggling. The U.S. is broadly energy balanced, and so it's a good benchmark. And of course, the Russian ruble continues to strengthen beyond all expectations because ultimately Putin holds a lot of leverage over us, leverage that we gave him.
So, Doomberg, is there a spot where you think that breaking point for those countries that are energy dependent or net energy importers, where it really starts to affect either their economies, their population. Like, how do you think about where we're going to see or what some of the symptoms of that system starting to kind of break apart is?
So economies in general, and especially globally interconnected economies, are nonlinear systems, and they are sensitively dependent on initial conditions, and they're very difficult to model. Having said that, you can look for milestones and signposts, as Luke Groman would say, for just such disruptions and social upheavals. And we're seeing that today. We're seeing that in Turkey, a net energy importer combined with an insane monetary policy. They're experiencing hyperinflation, 75% year-over-year inflation, and don't seem to be taking the necessary steps to bring this under control. And so we watch the Turkish lira carefully. Of course, Sri Lanka has undergone basically societal collapse. That's a combination, again, of some questionable internal policies around the speed with which they tried to move to organic farming. But still, these are the types of decisions that have severe consequences in an energy shortage that might otherwise have been easier to paper over in more traditional times. And so energy is always life, but it's becoming very, very apparent in this environment. And I would say, there's many people who watch FinTwit and think that the sentiment is so one-sided and that this means somehow there's going to be a pullback, maybe even a substantial one, or in fact that, the energy cycle may have peaked. And that might be true. We're not investment professionals and we don't give investment advice. But in a time of shortage, physical trumps paper. And we would argue, and again, our friend Tony Greer would argue that if you look at the percentage makeup of the S&P 500 that energy companies contribute, it's still historically small by any measure. And we seem to have a long way to go before we would get to sort of extreme overbought levels. These prices feel extreme. $5 gas and $6 diesel feels unprecedented in the US, but we would also point to the fact that these prices are significantly higher in Canada and Europe. And so we could see $10 gas this summer, average, if things play out. And so it's an unprecedented time. We're not going to be the ones to call the top. Trying to call the top is a dangerous game. I think the rules have changed. That's dangerously close to saying this time is different. But what makes this time different than the past, say, 15 or 20 years is we are in a true energy crunch, which was totally predictable, driven by a lack of investment in the primary energy producers. And that puts a cap on GDP growth. It puts a cap on the amount of standard of living we can distribute, which is effectively another way of saying GDP can't grow without growth in energy.
So do you share the same sentiment, let's say, as Steve, where we've really kind of hit that peak oil moment of energy return on investment?
Yes.
Or is it and going forward we're just really expending more energy just to get the same amount or less back, right? Steve, do you have anything to add to what he was saying?
Yes. Until he gets back. And I think the important thing, he brought up a good point. We're at this new inflection point because I've been talking about 1970 was the beginning of the inflection point, and then it happened again in 2005. 1970 is when the U.S. peaked, and we didn't have any volatility in the oil price from 1960 to 1970. It was $1.85, about $1.85 or $1.82 a barrel. And so we had the Cuban Missile Crisis, we had the Vietnam War, all these huge geopolitics that were taking place, even bigger than you could say what's happening maybe in Ukraine. And so we didn't have the volatility. And the reason why we didn't have the volatility is because Texas was still bringing on production. Oklahoma was bringing on production. Saudi Arabia and the Middle East was bringing on all this production that was discovered in the 40s and 50s. But now that's over. And what's interesting, the global oil industry is still trying to get back up to the peak in November 2018, which was the OPEC and non-OPEC was about 84 million barrels a day. And that's just crude oil and condensate. We're 4 million barrels less. Now, from 2009 to 2019, we added 13 million barrels a day of total liquids, and most of that was the U.S. and Canada. So now we're not going to have another 13 million barrels a day. And I mentioned that in our last talk, but that's very important to understand, because the 13 million barrels a day, even though a lot of it was shale, crappy shale, low energy return on investment shale, as well as very low energy return on investment oil sands, it still allowed business as usual. We could still manufacture cars cheaply in China, but that's done now, because you can see what's happening in China. It's very hard for them to be the manufacturing powerhouse of the world when commodities and energy prices are skyrocketing. So the whole thing starts to fall apart. And even if the global oil industry is able to get back up to what it was producing, the decline rate now is like 11 million barrels a day. That's the decline rate when you factor in OPEC, non-OPEC, and shale. That declines 48% a year. And so when you're facing those dynamics, it's hard just to remain at 100 million barrels a day. And one last thing is that about the problem with ESG and going green. Yes, some of the oil companies have not been investing in exploration and development, but even when they did that a decade ago, and I mentioned this figure, the top oil companies spent 170 billion in 2012, and it didn't really get them much in the next 4 or 5 years when the oil price was over 100. We didn't really find that much more. So the executives are looking around, well, we're not really finding that much more good quality. There's a lot of crap out there. There's 1 trillion barrels of crappy oil shale. That's different than shale oil. You got to crush that. You've got to extract the oil from it. There's 1 trillion barrels of that in Utah and Wyoming, but its energy return on investment is less than 2 to 1. And then there's trillions of barrels of methane hydrates off the coasts around the world. But that stuff's really bad. It's not even economic to get it out of the ground. So that's what we're facing now. This is the problem we're facing. And I think the cliff-like declines are coming ahead due to the debt starting to implode. And that's what we're facing.
I agree completely. And just to build on that point, because of the financialization pressures of Wall Street and national policy of China, we've outsourced to China the manufacturing of many energy-intense industries, like polysilicon for solar, or a lot of chemicals, and so on. And now that China's a net energy importer in severe deficit, they were caught flat-footed with the natural gas crisis in Europe, which led into the LNG markets for gas, which caused substantial price increases for the Chinese. And then you see the first thing they do is they stop the manufacturing of energy intense commodities like magnesium, aluminum, and polysilicon. And those prices have skyrocketed. And that, sort of a doom loop, exports inflation, because while our manufacturing capacity in the US is at a significant advantage, that advantage is, of course, shrinking every day as natural gas arbitrage closes. They are nowhere near capable of replacing the manufacturing capacity that we outsourced to China. And then this is all made even worse by the fact that for significant metals and minerals that we need to run the economy, we've outsourced that to developing countries because of NIMBYism here. You can't get a new mine permitted in this political environment in the US. And then those countries are the victims of the inflation that we're exporting. And if you take, we've harped on this before, but the food situation in Peru, for example, where we have these huge copper mines, and Chile, you're starting to see political instabilities in these critically important regions that are critically important, at least in part because we have outsourced to them the development of these critical mines that drive at the very front end of the economy.
Guys, I have kind of a question. Doomberg, you mentioned this as you called it, the doom loop there, and I want to know how you think about when people talk about the supply chains kind of coming back online and coming back to normal. If you see any possibility of that happening, or these, as you said, these kind of doom loops just start feeding on themselves, shortages feed into shortages and create all kinds of downstream effects all down the chain?
Well, the big concern, of course, is the institutionalizing of inflation expectations in the Western world, which is not something that we have experienced in the institutional memory of the median investor participating in markets today. And we wrote about this very early on in some of our first pieces. This is the first inflationary spike that is characterized by two important attributes. It's the reserve currency that is experiencing elevated inflation, negative real yields of 7.5%, which is really amazing how far behind the curve the Fed is, and the US dollar being the reserve currency. But perhaps more importantly, or at least interesting to us, is that this is the first inflationary pulse we've had during a hyper interconnected social media driven world where things can go viral. And who chooses what goes viral is an interesting question, and might not always be people that like us. We wrote a year ago what happens when a video of the first $20 Big Mac in the US goes viral on TikTok. And how does that shape inflation expectations when information is so raw and so quickly proliferated across society, like literally overnight? And so we're seeing that today, with pictures of $9 a gallon gasoline in California. And we're sure that this is just some isolated gas station in a really good location that can gouge a little bit and get away with it. But that shapes expectations. And we've questioned whether our monetary overlords at the Fed have the faintest idea how inflation expectations can both be shaped and manipulated using the powerful tools of social media. And this is truly uncharted territory. And so there is this, inflation expectations boogeyman out there that nobody can predict how that's going to unfold.
And just as a counterpoint there, Doomberg, in Canada here, we probably have close to the lowest prices in the whole country. I'm paying, it would be equivalent to $7.20 a gallon for gasoline, for regular gas. So it's in a place where, in Alberta, where we have tons of oil and gas, much of it is produced here. We still have that kind of cost associated with just regular gas.
Yeah, it's crazy. And what's the next step from that, which is political upheaval? And so we have not been big fans of the Trudeau government, for those who have read our pieces. And I think it's amazing to think that Canada is a huge net energy exporter. And at the same time, much like Australia, they're paying record high prices for these energy inputs. And so that is, as we would say, an unsustainable situation.
Yeah, Francis, we were waiting for you a sec.
Yeah, that's fine. Thanks for joining us. Nice to meet all the other guys, and thank you to all the followers and to you for putting it together. So I'll take a minor step back and then just go macro back in, if I can come in, I might cause a segue of some form. Energy, dollar, and metals. That's the discussion. And we're talking peak energy, dollar strength, and precious metals. And my take is, I view oil as the original global tax, the New World Order kind of global tax. People need to see it as a cost that's certain parties have controlled macroeconomically the world over for quite an extended period, and that there's been some degree of coordination through that. I view the dollar as obviously the seminal currency, and quite a bit on that now in terms of how it plays. We're having an inflationary era, and the key point on the dollar for everybody to understand is that Triffin's dilemma, essentially America is designed to be a deficit runner and an exporter of dollars. And as a result, they consume products from the East, often in Europe, and they send over dollars. What's happening in terms of the dollar is that because of inflation, because of the retail consumer being crushed, houses dropping, in cost of credit cards going up, cost of mortgages going up, cost of everything going up, what ends up happening is the retail consumer in America, who is actually the driver of the export of dollars and the importer of goods, ceases to import goods from
countries like Japan, for example, which we'll get to in a minute. And so the dollar flow is not going out. So you've got a combination of oil, and I'll come back to oil, but it's almost important to understand the dollar and the debt system as well within all of that, and how oil is the lubricant around all of that. It's the engine and the machine parts. And then there's gold, which you mentioned. And while we're looking at the dollar being strong, one of the many currencies now, well, the three currencies that are not being weakened by the dollar right now is the Chinese yuan, the ruble. Since its blow off, it's been the strongest currency recently. I actually think it's the best fundamentally backed currency now, where previously, literally until the changes, it was the whipping boy through all of it. That doesn't mean it's proliferated. That doesn't mean everyone can go buy rubles. But the whole concept of the FX structures is now dollar dominance is causing a lean. And then now, instead of sending the dollars offshore, they export inflation to Euroland, because the Euroland's currency is going down, and the yen's particularly, but the Asian conglomerate currencies will also go down because they're not getting to sell their goods. So you've got that currency effect where there should be a circulation from west to east, and there has been, and now debt has built up so strongly. Going back to the oil, when we called short to single digits in the great collapse, that was a function of America becoming independent on oil. And I think that was done via intent. A lot of sub-economic non-decisions were made in terms of fracking, both in not just America, but in other current countries as well. And what that did is that took America independent for a short period. That was during the Trump era. What that then did is, for all the nations that they were squeezing, the oil producer nations, which that didn't have Royal Dutch Shell or British Petroleum or the ex-Rockefeller groups, the Zenons and all the fragmented components, getting the bulk of the benefits. They squeezed Venezuela, Iran, and Russia, all the bad guys that they wanted to squeeze. And what happened is those people needed a certain amount of revenue, and they overproduced to try and still make that number, which caused the glut that led to the single-digit call and the negative run on the futures market. So this is how things happened. There was an entire energy axis attack on unfavorable nations. To further magnify that, Russia had been under attack on uranium as well. It's obviously uranium, natural gas, and oil. The whole events of Fukushima, there's a large rabbit hole for you to jump down in terms of the events of how Japan got taken off it, and then Germany swore off nuclear, only now being reversed. That sees energy. So when we're talking energy, we have to think of all energies as well. And that was again to squeeze Russia's balls for this blow-off move that happened in the ruble. They were sitting on a huge amount of decommissioned uranium that was highly enriched, that you add back a little bit of, you almost dilute it down, it's called tails, and you end up with an immense amount of energy supply for nuclear producers. So we had the whole attack on Russia, that was 2014, I'm taking it quite a way back, where the original Ukraine Mark I occurred, which was where essentially Ukraine was turned into a hostile nation to Russia via the NATO expansion, and as a result, they lost everything bar Crimea, where previously it was an ex-Soviet state, and now they're trying to counter that. So there's quite a lot of geopolitics in all of this. Where does energy, dollar, and gold all end up? The macro element is the hyperinflation is driven through energy because it's in everything in packaging. It's the biggest addition. It's in everything in terms of that, and it was your original global tax long time ago, and we have, as other people, the esteemed speakers have already mentioned, we have $250 plus events. And what's happened is, with the fragmentation of the supply chain with Russia splitting in the world into two, is that you're actually got less places to source that from, and that ensures the inflation. So my personal opinion is we have a government that is intent on raising inflation. We came in on a higher inflation number and a lower sentiment, underestimating the effect intentionally, so that we will have a debt spike in terms of yield and a collapse in the debt markets. For a new system to come in, you have to kill the old, which is the debt markets, and that's going to be driven with dollar strength, beating up FX emerging. So I've given a lot of macro themes for other guys to mine on, and I don't want to overtake my time, but that is how it all plays in. And with the fiat stick of the dollar will be used to beat the others first, and the biggest major being attacked is yen. But don't forget the Turkish lira, which is super high indebted, very low reserves, has already been a long story that we've been all over on the FX markets as well as on the yen on the FX markets. We're holding out for the Korean won. The other Asian nations aren't going to let Japan get an export advantage now with such amounts of devaluation. So you're going to have regional-based devaluation, and again, the knock-on the emerging nations. So this is a kind of global chess game that must be viewed. I totally respect the guys that are speaking right now, and they've got such detail. But sometimes for the people that can't retain that amount of detail, understanding the macro flows of the global unit and how it all works and what is the intent and where it will take us is all they really need to grasp to know how to position to come out of this well. And I'll hand over the talking stick, having locked on for a bit.
Thank you, Francis.
Hey, Tom, do you mind if I chime in? Thank you, Francis, on that. I totally agree. That's why I try to keep keep it simple, stupid. And I didn't realize how important energy was until I picked up a book called The Forest Journey, because the late Bronze Age and the ancient Roman Empire wouldn't have become empires or huge civilizations without cutting down massive amounts of wood and making charcoal to smelt metals. And that was the case up until the 1700s, when the British figured out how to use coal to smelt iron than wood. And we were still doing that in the States. And then that's why the British was such a powerful empire, even though it lost the U.S., the United States, in the Revolutionary War, because it maintained this technological advancement of using coal to smelt iron. And so that's where you see a lot of these very wealthy castles in England and all these period pieces. A lot of that came from the iron and the sugar trade. But when it comes down to energy, it's very important to understand energy is a derivative of money. And so, it used to be gold and silver, because gold and silver, I call it a store of energy value. What we've done is we transitioned to a paper money system, which is more efficient, but we've got all this paper money out there, and there's just not enough energy to back all this paper. That's really what it comes down to when it becomes a Ponzi scheme. There's way too many dollars, and there's way too many euros. There's way too much of this paper, and that's not even including all the financial assets, stocks, bonds, real estate. And so when you factor all that in, this is the problem the world is facing. And when we start going what I call over the energy cliff, the world is going to be a much different place, where unfortunately, there's going to be maybe a new regime change, they call it a new global system, financial system. There may be, but when you have less energy in the future, and that's where we're headed, just like the Bronze Age, just like the ancient Roman Empire, when you have that kind of future, then the thing starts to implode. And that's what the Wall Street and the financial analysts don't seem to be understanding. We're heading towards a slow and then building up collapse of the global economy, because the energy that runs it, is that the energy return on investment continues to decline. And this is a major factor when we remove all the derivatives, all the details. The energy is the most problematic, and that's going to thunder throughout the entire economy. And unfortunately, I believe by 2030, we're going to start really declining in global oil production. And what have I said? You can't increase coal production unless you have increased oil production. Why? Because it takes diesel machines to extract coal and transport it. And we know China is they're going to produce 4.5 billion tons of coal this year. And how are they doing that? They're consuming a lot of diesel to get that coal out of the ground and to their power plants. That's the same way in the rest of the world. It's the same thing with natural gas. Those natural gas wells are not being drilled and extracted with energy tooth fairies. It's trucks, it's equipment all run by diesel. So when oil production declines, it's going to pull down the production of all these other energy sources and even metals, and the entire economy starts to roll over. And that's an unfortunate part that the financial industry and market hasn't figured out yet.
Can I say something on that as well? That was a very interesting statement. I don't assess that we have ever had peak oil. What we've had is we've had peak $30 oil, peak $50 oil. We don't have peak $350 oil. I think what the key point I'd like to highlight in one of the previous commentators is they've intentionally or disinvested in the traditional energy sources during the COVID period, intentionally. So this has been a manufactured almost crash, part of which had to do with the fact that the price collapsed to near zero, and as a result was non-economic. So you went from having 300 offshore grids to 3. And what that actually meant is you killed production, and you don't just switch it back on. You don't just send out a swathe of oil rigs. I think the economic ability to get good value oil, the cheap and easy oil, is done. And it's also a factor of the devaluing dollar as well as diminishing returns in resource extraction. But generally, technology has done a fairly good job, although I would say the fracking is very marginal an activity. So I'm not a peak oilist, but this does dovetail with engineered supply chain related matters. A lot of this is being enforced because of insufficient new fresh investment. And I don't think people sometimes think peak energy, they try to tell you there's a limited supply of water and oil. I don't think we've reached that, but we've certainly reached the very easy stuff. And that's something to bear in mind. And it's also a function of the dollar and the debt system. In its devaluation, you're going to have to pay a lot more for energy because you're a monkey on a greased pole as well.
Tom, if I could just say one more thing, and then I'll let other speakers talk. It's important. Francis, you bring up a good point. What's interesting, as I mentioned before you came on, the global oil industry was pumping in a lot of money when oil was over $100. And we haven't found much oil. Matter of fact, we're burning 4 barrels of conventional oil for every barrel we discover. It doesn't matter if we find a lot of unconventional, low energy return on investment of energy sources, even though the price of oil could go to 150 and 200. It's not the price, it's the quality of oil. And I'll tell you why. The one of the leading minds on the energy return on investment is Charles Hall, and they calculate this high-tech global economy. See, people think technology is more efficient. It isn't. It's just a massive consumer of energy. So when you add more technology, you're just consuming more energy in the entire system. So we need roughly 12 energy return on investment from oil to power this massive global economy with all this infrastructure, all these moving pieces. That's what we need. And if you don't get that, what shale is 5-to-1, oil sands is 4-to-1. What you do is you pump in the debt. So the debt is being used to offset the falling energy return on investment. So it doesn't matter if you throw $1 trillion trying to find more lower energy return on investment energy. The market needs 12 or more to survive. And why is that? Because in the United States, we burn 10 calories of energy to put 1 calorie of food on the dinner plate. That's a huge net energy loser of 10-to-1. Well, a simple farmer back in the day, a serf, he expends 1 calorie of energy to produce 5 calories of food. So technology, with all this wonderful technology, we're just devouring energy. And that only works when you have an oil source that has a high energy return on investment. And each year this has fallen. So it doesn't matter how much we spend, the energy return on investment does not lie. And that's the problem we're facing. We can find 1 trillion barrels of this or 1 trillion barrels of that. But if its energy return on investment is too low, it bankrupts the economy. And that's what we're facing. It has really less to do with peak oil than it has to do with peak quality oil. We have run out of peak quality oil, and we have maintained business as usual by using a lot of debt to bring on low quality, low energy return on investment. And so the party has just gone on for another 10, 15 years. And now that party is getting ready to be over, unfortunately. And that's how my analysis looks at this situation.
And Tom, I would just say this is what makes our policy stance on not only developing new nuclear power technology, but also maintaining the existing nuclear power fleet that we have so insane. shutting down nuclear power in the middle of an energy crisis is literally the dumbest thing we could be doing. Mm-hmm. And yet the same political leaders that put us in this predicament are, stubborn in their insistence that for quote reasons, they don't like nuclear power. And I would say this foreshadows what I fear is a series of, let's just call them revolutions. We're going to see how can the euro survive in a true energy crisis. We're seeing far right-wing leaders around the world becoming more popular, and such populist leaders are going to take the steering wheel back. There will be violence, like we've said many times, on the path from abundance to starvation as riot. And we're going to see that societies will become severely disrupted. This is not just going to be everyone is going to sit around and accept it. And so we're playing a very dangerous game here, and the outcomes are not good ones.
I totally agree. And I want to get to the nuclear kind of question and component of how we move forward in the world with a new, I don't want to say maybe a renewed source of vigor for nuclear. But before we get to that, I wanted to get each of your opinions on why you think, let's say, Wall Street or whoever you want to say is in charge is missing this. Do you think it's recency bias? Do you think it's the fact that we take for granted how much abundant energy we've had for so long? Why do you think this is, or is it maybe intentional? As Tom Luongo, a past guest of the show, says, if you look at the incentives or the actions of all involved and you realize that they are vandals of the system rather than trying to actually make these short-sighted policy decisions that seem so counterintuitive, it makes a lot more sense that they would be vandals rather than actually, doing their best.
So we're not ready to be in the it's all on purpose camp, although I would be the first to admit that is a hypothesis that is getting harder to nullify. We remain in the incompetence camp. And I just think that our political leaders have no relevant industrial experience. They have no attachment to the reality that the people they claim to have a mandate to lead exist in. And they literally, like Christine Lagarde's tweet about fossilflation the other day was so absurd. We included it in our latest piece. It's so out of touch. And, these people attend cocktail parties and they think the food just shows up. And I don't want to live in a world where it's all on purpose, because the consequences of accepting that hypothesis is pretty depressing. But I'd be the first to admit it's getting harder to nullify it.
I'm the depressing guy. I think is coordination at a very high level. I can't see it. The one thing is, there's that famous saying, don't put down to intent where incompetence will do. And many people put that out. But I think there's certain things that, and there's certain patterns that keep reemerging that can't be ignored. I just have to look at the World Economic Forum and the intention to bring in central bank digital currencies. So I think, well, how do you kill an old system that is over indebted? And you continue to generate debt, as the predecessor who came in on the oil after me. Fracking was not nearly as economic as the old method. You added a ton of debt. Eventually you couldn't get investors. They were losing money. The banks funded these guys. You created a balloon of debt on non-economic oil. Generally, people don't sell $10 notes for $6 on street corners. And what they do is to create a glut, a temporary situation for which debt is, remind me tomorrow, it's all going to go to hell in a handbag at some point. It's so big, it's going to break. It's never going to get paid. What's a couple more? And this is just the pay me tomorrow mentality. But it's an encouraged mentality, and it's all part of completing a cycle. So if you study cycles, it's intent that they expect a certain system to last a certain amount of time. The more they abuse it, the shorter that time will be. We are all living in very interesting times. We're living at the arse end of a macro cycle, in my opinion. And debt, it is a debt system, and it will fail on debt. And at the moment, debt is being held up everywhere. The simple law of economics is supply. Something something that is vastly supplied should come at a very, very cheap price. In other words, a commoditization, buying a pair of socks or underpants. Debt is highly valued, never been stronger until recently, of course, and it's the most proliferated item ever. And the question becomes then, who is this huge mega buyer? Well, it's your pension funds, but now more recently it's become governments. It's quite clear from a simple 101 law of economics that such an extension of debt, don't forget the US issued 25% in a space of 18 months. I'm not sure I've got that exactly correct. It's somewhere around there, of new money, which is new debt. Remember, money is borrowed into existence. And with an tertiary extraction interest rate, which is currently going up as that debt devalues, that no one can pay, which is your thermostat full breakdown. So this is, you can't not know this. This is simple mathematics for me. And for me, it's by intent. The gold is the final store of value for me. Our short call on oil was based on the gold to oil barrel value. So the other side of that was actually a long. And if you saw of gold while the short was on, so we do relative valuations. And since then it charged up, it met all our targets and has been in a pullback gestation period. But if you look at it against any other currency, the yen, for example, it's doing exactly what it's supposed to be doing against the euro, the pound, very close to highs. And the big moment will indeed come. And precious metals investors have had to have the patience of monks, but you will be wrong, and suddenly so very damn right. And that's the only thing I can say. And that patience will be rewarded. And it brings up issues such as confiscation. Should you be numismatic? Should you have a gold chair that it's furniture they're confiscating, which they can't do because it's not monetized? There's all other sort of discussions I'm already having about how you protect against that. So that's where I stand on incompetence or intent. At the very top, it's intent. There's plenty of incompetent people below who will mutter and make pathetic tweets. Of that, I'm very confident as well. So that doesn't mean there's no shortage of incompetent remarks made from lawyers acting as central bankers. But I think we have to go at the Kissinger roundtable. It's intent for me.
Tom?
Oh, okay. Do you mind if I
Steve, jump in, and then we'll get to you, Jim.
Okay.
I'll try to make this quick. I think it's a combination of both, but it really, in the end, it doesn't matter, because if we go back to ancient times, the mankind has been in the same predicament over and over again, and the reason why the Roman Empire fell was due to the falling energy return on investment of its wood. And there's no coincidence that we see the Roman legions going up to the Germanic area, which that's where the wood they needed to access more wood. So the problem was they ran out of a lot of wood that they were using in Italy and in other parts around Italy, but then they had to go up and to attack the Germanic areas to get more of this higher quality wood. And at a point in time, the empire got so big they just could not get enough wood. And I estimate in a 50-year period that the Roman Empire cut down 1 billion trees. So if we fast forward to today, we're hitting the same problem. And the problem is the energy return on investment is falling. And now we're using debt to offset that. So what happens as energy production falls? It doesn't matter what the governments do. Because at some point in time, energy allowed centralization. The loss of energy is going to destroy the central governments. Matter of fact, in time, a lot of central governments, in the United States, in the West, even in Asia, they're no longer going to function that well because the energy is not there. And so this is an aspect that the market, and lastly, I make a joke because I talk about precious metals as a store of energy value. Stocks, bonds, and real estate are not. They're energy IOUs. That's why they're going to be very problematic as we go over the energy cliff. Precious metal people I talk to don't care about energy. Most of them don't. The energy people who understand the problems with energy don't care about precious metals. They're staying with their paper retirement accounts. I don't get it. And then the worst are the financial guys, the economists. They don't understand really energy, and they don't really care about precious metals. And so this is the crazy dynamic. I think it's a combination of both. But yes, I think we're going to see a big movement in the metals because it is the only real thing that can store energy value, which is wealth for the last 2,000 or 3,000 years. That's always wealth has been storing energy value, which is the number one driver of all empires and civilizations and economies.
Thanks, Steve. Jim, you wanted to add something there?
Yes, sir. Thanks very much. We've had a discussion nicely about supply so far, and I guess that if I can maybe just hit on demand a little bit, and maybe Steve can give his opinion when I'm finished. It'll just be short. I'm a futures broker, and normally in a normal, simple economic model, you would say if things are in abundance, the price can be low. When things start getting bid up in price, the demand slackens off a little bit. And you would call that elasticity. An economics guy would call that elasticity of demand. In oil, since about the late 50s, 1960, people started getting pretty good jobs. And then in the mid 60s, in the late 60s, early 70s, they found out that if the wife went to work also, instead of having 4, 5, 6 kids, we might have 2 kids. The wife is going to go to work. And so all of a sudden, the $14,000 homes went away and they started becoming $16,000, $18,000 homes. And they were $25,000 homes. And where were they? Well, they built them in the suburbs. They built them in the suburbs because they could get a nicer house rather than an apartment in the city. And what did that mean? Well, that meant if the husband drove to work, well, now the wife has got a job. She's going to drive to work. So we became a nation of 2-car families. Then all of a sudden, in the mid 70s, we had an oil shock, and oil could go up 4 times. Gasoline would go from 25 or 27 or 28 cents a gallon to 50 cents, 75 cents, $1 a gallon. But what my point is that in the United States now, we are at the point where the people that had the kids, they had the 2 kids. Well, 3 generations have happened since 1950s. All right. I'm an old guy. And my point is that as the price has gone up, the people still need to have the gasoline to get to work. Mr. and Mrs. Smith, Johnson, Brown, etc. And the price of gasoline, it's been a real hurt for folks in the last 12 or 18 months because we've gone from $2 a gallon to almost $5 a gallon as a national average now. I realize Canada charges in liters. So my point is that instead of an elastic market, we've got an inelastic market where pretty much people will start maybe giving up their cable bill in order to put gas in the car and food in their stomach. But we're not having a fall off in demand because we really can't have a fall off in demand because our economy works around energy to get to work, to earn more wages, to pay the gas bill, the electric bill, the mortgage payment, and the 2-car payments that most families have. So it's inelasticity, folks. It's not an elastic market.
Yeah, it almost seems, Jim, you're saying that there is some cushioning, right? In, like you said, cable bills, stuff like that, but we've also seen consumer credit cards jump right back up to almost their some historic levels here. So, maybe it's hard to gauge how much cushion the average consumer really has.
Yeah, I guess I wasn't speaking of a cushion, Tom, in that regard. I was just, my point is that, if people's families wanted to buy a speedboat or they wanted to buy a lake cabin or something like that, maybe 2 or 3 or 4 or 5 years ago, before we had $120 crude oil, that might lead them to say, well, we've got $400 extra a month, or we've got $2,000 extra a month. Now, one part of it is you can't buy a new car because there's no inventory due to COVID. And the other part is to fill up your Suburban or your Tahoe or your minivan, or it's $70 instead of being $30 or $35. So the extra is going away. And maybe, Tom, that's what you're getting at, is that instead of having extra, it's eating into the credit card balances. They're going up a little bit each month too. But it's going to be, I mean, there will be some drop off in demand, but it's going to be other things. When you fill your car, you won't get a pizza on the way home to bring home to your family. Or when you fill your car, you won't buy groceries on the same, until payday, until Friday or something like that. But people have to have energy, I guess, number one, to turn on their lights in their home because it gets dark, but they have to have energy because that's the mainstay of the economic unit, the family, because Mr. and Mrs. Smith, Johnson, and Brown have to go to work.
So we have a slightly different view, and it's not necessarily a view, it's a question or a hypothesis, which is, if we were heading into extremely elevated / borderline hyperinflation, the smart thing to do would be to run up your credit cards. Because paying off the debt in future dollars nominally is a pretty wise decision. And one wonders, and we would be the first to admit this is perhaps a bit speculative, but whether or not this run up in credit card debt that we're seeing is not in fact a manifestation of inflation expectations.
That's an interesting idea, Doomberg. I like that.
I don't think the U.S. consumer thinks one iota, gives it 10% thought that says, I'm going to max out my credit card because when I get a raise in 2 and 3 and 4 years, I'm going to pay off my credit card with cheaper dollars. I don't think they think that way. I think that they figure that, well, I've worked hard all year. I deserve a vacation. I'm going to Orlando. We've got a credit card. Let's charge the airfare, that kind of thing. I don't think they think necessarily about inflationary dollars.
Okay, so if they did, imagine what that would mean. I guess is our point. Again, it's since I think the wisdom of crowds is perhaps a bit wiser than we're giving credit here.
I think the billionaire class know that. The billionaire class that have borrowed exceedingly cheaply, for which there's a hurdle rate that is really low, are the ones, and this is the great secret of inflation. It is an enrichment tool of the 1% of the 1%. It absolutely is, because they have access to super cheap credit. Credit card, I don't know what the rates would be in the States, but they're pretty high here, and they're still above. There would still be a positive real interest rate generally to the inflation rate, although the inflation rate is coming immensely fast up if we check shadow stats and all of those. So I would probably say I don't think the average American consumer is doing that tactically, although you're right to think about it as a strategy, because I've contemplated it. I've essentially purchased properties for cash that I'm considering putting mortgages on that have subsidized rates because of the areas I'm investing in, on the basis that I will be paying that back in diminished dollars. So I think it's a very interesting thought and point. I just don't think it's one that people that are pressured have the option to choose on credit cards.
It builds on the point that we said earlier, which is that this is the first inflationary spike in a period of time where we have hyper-connected social media. And so what one might assume the average consumer thinks, sees, or believes may not be traditionally accurate. And between Facebook and TikTok and Twitter and Instagram, the inflation expectation game is radically changed. And I think if one is in the business of trying to understand how things might shake out different than expectations based on old models, this type of nonlinear thinking that I think is at least interesting to discuss. It's consistent with the hypothesis that perhaps inflation is running hotter and people are onto the game a little quicker this time. But again, first to admit that it is a speculative hypothesis, but it's certainly fun to contemplate.
If I could add also, I think you would see your hypothesis play out in the institutional market or maybe in the investment market first. I mean, if you look at gold as a percentage to the S&P 500 back in 2011, when everybody was thinking the dollar was going to go, the way of the dodo bird and collapse, you had gold as about 1.6% weighting to the S&P 500. Today it's only between 0.5 and 0.6%. So you don't see at least an investor attitude expecting inflation expectations or that currency debasement. Or at least you don't see institutions
but you're discounting the 2 trillion max valuation of cryptocurrencies and the Reddit YOLO crowd. We wrote a piece, our second piece ever, I think it was called "Every Doge Has Its Day," and we wondered whether people were so frantic to get out of fiat and into literally anything, including Dogecoin. And the institutions are members of the privileged class that we referred to earlier, who have other means to. They have access to credit. They're invested in the traditional model continuing to work. I would argue that if you look at sort of credit card debt and you look at the proliferation of the YOLO market nihilism, as my friend Dimitri Kofinas would characterize it, these are all signposts that are consistent with a collapse in confidence in fiat currencies.
But with the crypto market, though, would it be a collapse in confidence, or did it turn into a mania in terms of price speculation?
Yeah, I'm not sure that's a distinction with much of a difference. To this generation, Bitcoin is their version of gold. Whether we would think that is a serious statement or not is not super relevant to the decision making of those individuals, the next generation. And so this move of Bitcoin from 4,000, I guess it was in March of 2020, all the way into the mid 60,000s would have been what we might have anticipated gold would do, but we're not the marginal. Our generation may not be the marginal speculator here, the one that has the longer you have to stay in the system, the more inflation is a big risk to you. So anyway, just pointing it out, there's signposts there for sure, and for sure, pattern recognition might be a strength, but also a weakness. You tend to see patterns everywhere if you're looking for them. We are not totally unsurprised by the credit card data coming in as people ponder what consecutive 8.5+% CPI prints really mean when the underlying data would support more like 15 or 20%. 20% inflation doesn't take long to destroy a person's savings, and almost anything is worth more than fiat in that scenario.
And just to kind of add to that, Doomberg, I spoke with Doug Casey the other day, and as much of an old school, let's say, gold bug as he is, doing some research for our interview, I came across him saying that even he sees the potential of Bitcoin, at least as a transfer mechanism, out of any type of fiat that the government imposes capital controls on, right? So whether you're using it as a speculating tool or a transfer tool out of whatever fiat currency that you might become trapped in, at very least it has a value to transfer some of your wealth, right?
And if you go back and read the histories of hyperinflations, they're often characterized by, in the early signs of it, manias, like the ones that we've seen unfold in the post-COVID era. And so we spent a lot of time thinking about what do the members of such societies think in the moment and what drives their behavior. And then are we seeing similar signs today? And when we wrote that piece a year and a couple of months ago, inflation was still very tame. Don't forget. But now we see, if you do print so much money and you have supply crises and you have an energy crisis with diminished energy return on energy investment, you begin to see these kind of weird behaviors. And if you go back and the interesting, and Rudy Havenstein, who has weirdly and unfortunately been canceled off of Twitter, but has a great Substack now, he wrote a really fascinating Substack a few days ago, earlier in the week, where he just quoted from historical tales of the Weimar hyperinflation, and personal accounts are the ones that you need to read, not the sort of official historian accounts. And the consistency and the behavior, the crowds are wiser than we think. We keep a close eye on the crowds. Let's put it that way.
Yeah, I like that narrative. I read the same blog on Rudy Havenstein, and I found it fascinating. I would just differentiate digitization and the fact that government wants us all to move digitization. And I would divide it between those that know their history well, that read blogs like Rudy's that was being referred to by Doomberg there, and those that are all rah-rah the new world. And I fear for, I'm involved in crypto, I'm engaged with crypto dispassionately. I fear that it's the on-ramp for digitization and a far greater surveillance finance state. If you ask me for my phrase for these times, surveillance finance, surveillance everything, complete loss of secrecy. This is the great unspoken narrative that is undermining all these technological changes. And you get a lot of people that are into the exponential everything, which is why you should almost biased to more analog and organic and physically held solutions in my overall view. Not that they won't come under attack in their own way, however. And that doesn't mean Bitcoin won't potentially, after whenever this bear market is done, go to all-time highs and once again suck through momentum a lot of people in. I just think from an tax extraction point of view, from a monitoring as in following who's doing what, the surveillance era, I think the great safety and privacy and sovereignty is actually having something that somebody else doesn't know that you have in terms of your balance sheet. And that's once again brings me back to the attraction of precious metals, because A, they could cancel Bitcoin when they issue CBDC. I don't think that's going to happen. B, they can super tax it, or they can make it marginally very difficult to use and regulate it into a nightmare. And it just becomes the new tech with Ethereum and apps and dApps, all of it. And we've just traded a high beta NASDAQ, and your new world rotates in the metaverse, which is just like the old world, only more TV screens and less reality. That's a bit dystopian, I apologize, but I think the alternative is to veer back to that, to off-grid solutions and organic and physical solutions. And just before I retire, it was a very interesting point on the energy side made a couple of chats back. I think it was SRS Rocco on how, the wood and all of that tapering to eventually becoming sub-economic. Reinhardt and Rogoff did a very detailed study on debt, and the increasing of debt to a point eventually becomes futile, where you're creating more money than that new money actually generates in productivity. And that is in essence where we are, and that is the death of the old horse. And the digital solution is the channeling into the abattoir that those that I see are very high up orchestrating. And I think you have to be of that world, but also you need a foot outside it, lest you be cold. Hand my talking stick back.
If I can just give everybody an update, if anybody's interested, the gold today finished, up $22.70. The silver finished up 11.4 cents after a drubbing, both metals got killed this morning when the CPI announcement was given out. And they've come back at the end of the day. And the dollar, if anybody's interested, it's at 104.19. It's up 97 points. So kind of a rarity to see gold up with silver, up with the dollar, but gold and silver have been just walloped over the last about 3 or 4 weeks. So it's nice sign to see it finish higher today on a Friday.
Bitcoin and tech down as well. Bitcoin and NASDAQ down at the same time.
So I would just point out that there's a distinction between trying to understand what the crowd is doing and what we all believe they should be doing. And both statements are basically potentially true. So, for example, I own no Bitcoin and I own a lot of physical gold. So I'm firmly in the camp that to preserve the purchasing power for my family going forward, that I do believe personally that physical gold in hand is a superior way to do that. That doesn't necessarily mean that the motivation of the crowd as we're observing it isn't a similar mindset, perhaps improperly applied. And so I to the generation coming up, their entire cultural sort of ethos screams that digital currencies are your way to get out of the system, your way to preserve value with speculative upside. There's only so much Bitcoin. It's indivisible, blah, 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 blah. And so they can both be true. A behavior we're observing is a manifestation of the wisdom of crowds in a pre-hyperinflationary environment. And I know there's going to be all kinds of people listening who are deflationists and think that there's going to be a deflationary economic collapse as energy prices skyrocket. And that's probably true, and that's probably the base case. But since we're on a Spaces on a Friday afternoon, it's fun to speculate.
If I could ask you, Doomberg, and Steve as well, if the crowd is, let's say they're looking at the cryptos and they're looking at technology as potentially that hyperinflationary hedge, I guess you could say, if you guys are right on with regard to the energy side of things, wouldn't that actually be the trap for crypto being energy intensive?
Yeah, absolutely. We've written skeptically about the price of Bitcoin and the sort of, if you take the US dollar / fiat as your frame of reference, it's indisputable that with that frame of reference, it's a Ponzi, and it's a Ponzi that requires significant energy to maintain in the form of mining. There's far fewer dollars in the crypto universe than and crypto universe, of course, goes to all the altcoins and Ether and everything else. It goes well beyond Bitcoin, and this is something that the Bitcoin maxis get annoyed with us for lumping them in together. But it's nevertheless, there's far fewer hard fiat value, far less hard fiat value, and hard fiat is an oxymoron, but in this context, it works. Then there is mark-to-market claims that people think they own at today's prices, and we've long argued that a regulatory crackdown is coming because money is power, and the state will not relinquish that power without a severe fight. And the first step of that fight is to cause liquidation panics, and you'll discover just how much of the fiat has been pilfered out the back door by corrupt exchanges and front running and so on. And so, yeah, this is why we all know Bitcoin. If we thought Bitcoin was the tunnel through which we could survive the storm that we think is coming, I mean, it's called Doomberg. Nobody's coming to us for the optimistic outlook on the future. If we thought Bitcoin was the tunnel through which we could preserve the purchasing power of the assets we've worked so hard to accumulate, we would own Bitcoin. We don't. We earn money in fiat. We save money by buying real assets. And we invest privately where we can affect the outcome. That's our approach to getting our families ready for what's coming, and it's one that we can sleep well with.
Well, Bob, I totally agree with Doomberg, and I don't need to make this a long statement, but it really comes down to the 3,000 years of using the metals as a store of energy value. Because why? That's the economy. It doesn't matter if you're manufacturing and selling jeans or cars. It's energy you're using to make that jean and to produce that car. Without the energy, there's no jeans, there's no cars, there's no homes, there's no economy. So the profits in the past have been put into gold, and the energy profits have been put into gold and silver. The wealth has been stored there because it takes a lot of energy to make gold and silver. So it's been an accountant of this kind of energy. I don't have a problem with people speculating in Bitcoin, but as I mentioned this in our past Twitter Spaces talk, it takes a massive amount of energy not only to continue to make the semiconductors that makes Bitcoin miners or Ethereum miners or the cloud system that runs the entire internet system, as well as not just the Bitcoin universe, the digital banking system. You got to replace those digital servers that we all use in the banking system every 4 or 5 years. And what do those use? Lots of semiconductors. And the problem I see is the semiconductor industry is going to get into serious trouble with resource constraints and the beginning of the breakdown of the global supply chain. And so this is the reason why I also agree with Doomberg, because gold and silver are decentralized. I'm not saying they can't confiscate, but if they do, they'll probably give you something for your gold and silver. But I can walk down to a pawn shop with my silver coin or my gold coin or my gold jewelry, and they're going to give me money for it. It doesn't take any special technology to do that. I just look at the guy, I hand him the ring. He goes, I'm going to give you $1,500. We're happy. Well, to do that with Bitcoin, you need a very complex system. That's got to be trading. You need Bitcoin miners to actually do a transaction to trade Bitcoin or to buy something in Bitcoin. So if people want to put their faith in that system that is highly dependent on a global high-tech supply chain run on energy, they can do that. But I would not recommend the majority of your wealth put in that system. That's how I look at it.
One thing I would also add is that if because I'm a believer, I think eventually you're going to see this game end, and people that even they're buying gold may not be prepared in terms of how they own the gold or how they own a structured program. They may be in the same boat as just owning an S&P 500 index or something like that. In that most institutions out there are into the derivatives and securities of gold and silver, not necessarily the physical metal. So that's the Achilles heel, that if you start to see this energy cliff start to ferment, you see economies start to implode, crime starts to increase, confidence starts to break down. It's a doom loop. I mean, it really starts to feed on itself. People start removing liquidity from their brokerage accounts, to protect their savings, and then that starts pulling money out of these institutional accounts, which are invested in derivative contracts versus the actual physical metal. It really turns into a complete disaster, where the physical metal could actually then start to sort of take sort of the pricing mechanism away from the derivative market.
Thanks, Bob. Doomberg, I'd like to get your idea kind of moving forward to the nuclear energy idea. I know you guys are big proponents of it. Steve, I know you have a bit of a different view, but I had an interesting conversation with a friend last night about trying to, let's say, replace some of this baseload energy or some of our energy sources with nuclear. And if we think about, let's say, trying to compare what we would have to invest, let's say, in resources alone to create a solar/wind/battery of some type, whether it be chemical, metal, or potential/kinetic energy battery, to be able to store that energy versus nuclear power plants. How much energy do we have to invest in either of those avenues to try to analyze them dispassionately versus what the actual output and reward is, going back to that idea of the energy return on investment for the amount of metals and materials that have to go into each of them. How do you see that balance coming out?
It's not even comparison. There's no comparison. It is, nuclear is the highest energy return on energy invested. These tend to be political numbers. Anybody who claims otherwise is either honestly not understanding or nefariously misleading. And let's just take a step back. We've talked a lot about energy return on energy invested. Energy is life. Your standard of living is defined by how much energy you get to waste. Disorder is spontaneous. And so our energy profits per year, if you view sort of energy as the real money, the energy profits that we generate net of the energy it takes to generate the energy we get to use, that gets spread around in a way using currencies to drive efficiency that we would call the economy. So if we just view nuclear power through that lens, the highest energy return on energy investment decision we can make is to keep an existing plant that's already built and producing gigawatts of baseload power operating today. It requires almost no energy. The waste is totally manageable. It's baseload power, so it's not intermittent, so there isn't second and third order effects and energy drags on the grid. This is the simplest decision we could be making, and yet we see California contemplating shutting its last nuclear power plant. The state of Michigan just shut down Palisades, ironically, a couple weeks ago. Germany is scheduled to shut down 3 more nuclear reactors. The energy profit that we have to generate to circumvent the loss of that baseload power, that high purity electricity, that highly ordered electricity that imparts such a great standard of living to so many people, is lost and then lost forever. And so the simplest decision is to keep the plants we have going on now. And let's look at what China is doing. Okay. Despite monopolizing the polysilicon supply chain, they have 150 odd nuclear reactors either under construction or in planning over the next several years. They see what it is that they should be doing, and they're doing it, and we can't over here. And so it's very frustrating, but we're huge proponents. We have a sort of 4-part energy plan. Let's get serious about energy. One is unleash natural gas in the U.S., pipelines, take off capacity in Appalachia, domesticate and reinvigorate the domestic polysilicon market in the shale patch. Polysilicon is produced by cheap energy. Get real and get re-engaged with nuclear. And then to the extent possible, we should pivot from battery electric vehicles to plug-in hybrid electric vehicles so that we can get a far greater gasoline abated per kilogram of battery materials when you spread the big full BEV across 4 or 5 cars. And so and by the way, just the signaling factor of telling the market that these are the types of decisions you intend to make would take a huge risk premium out of the market, in our view. So that's our view on nuclear. And you have to take our views on nuclear within the full context of our total energy policy. But there's no question in our mind that you will certainly not be able to decarbonize the economy to any reasonable extent absent nuclear power without causing huge famine, huge economic dislocation, social upheaval, and political revolution.
All right, Tom, I'd like to go ahead and because I do look at the nuclear industry a little different than Doomberg. I do agree, though, if you want to keep stable power, you do not want to reduce nuclear power. And he mentioned it, which is funny, ironic. We have the Palisades Twitter Spaces chat, and they just closed down the Palisades nuclear plant in South Haven, Michigan. And what's interesting, that provided 5.6% of Michigan's power. No relation. Yeah, so shutting down that plant last month on the 20th, that was 5.6% of Michigan's power. They've got 2 other nuclear plants. It's the FEMI plant and the DC Cook plant. They're larger, but that's 20%. It's 20% of the nuclear power was just shut down in Michigan. And you know what? That's an article came out 39 times all the solar in Michigan. 3.5 of all the hydropower in Michigan, hydro dam power, and 90%, about 90% of all the wind power in Michigan. And they've got 1,600 wind turbines in Michigan. And so it's producing a little more than 6% of Michigan's power, the wind turbines. But guess what? Those wind turbines last 15 years. And then the operating and maintenance costs become so problematic, they got to replace the wind turbine. So this is what's fascinating. Enter Energy, the reason why they shut down the plant, not because they had any safety issues, it wasn't economic. It wasn't economic. And according to a study, half of the U.S. nuclear power plants were losing money. And now this was based upon a year and a half ago, but based on that data, Enter Energy, who owns Palisades, they closed it down because they were spending upwards of $200 million more a year to power and run that plant, what the electricity it was getting compared to a natural gas generation plant. So that's the reason why they shut it down. Unfortunately, with natural gas now has just tripled in the last several months, they may think that was the wrong decision. So now we've got a lot of nuclear power plants in different stages of decommissioning. And I bring up Michigan because Michigan is typical of what we see happening in the United States. As Doomberg talked about, we also see it happening in Europe. China is different. They're adding nuclear power. But I think that's going to be very problematic for China. As I mentioned, what took the United States 100 years to become a metropolis, China did it in 20 years. And let me tell you, I keep mentioning this statistic because it's important for new people to hear what the U.S. cement and concrete production was in 100 years. China did it in the last 3. So they're building China is like Walt Disney World on steroids, all these high-speed rails to everywhere, all this infrastructure. And unfortunately, China's not going to have the energy to maintain this. And I don't think they're going to, my view is they're not going to be able to get to their estimated 150 nuclear power plants. They're really not going to have the energy to do that. And they're going to have too many Mother Nature issues. They're having a lot of floods in the southern part of the country, a lot of drought in the northern part of the country. This is just going to get worse as they've transformed this country from an agrarian country to a metropolis in the last 20 years. And let me just tell you lastly, and I'll shut up here. It's important to understand what's happening in Michigan. Yes, the world is switching from a stable coal and then nuclear to I call it just in time. And that's natural gas, wind, and solar. Because when wind goes down or solar, you have to bring on natural gas balancing power. But get this, in Michigan, as of February, natural gas is the largest source of their power. Coal is 27%, nuclear is 25%. Well, now they're also shutting down coal plants. They shut down the St. Clair coal plant last month. They shut down the Trenton plant last month, and that's 1,500 megawatts, and they're going to shut down another one next year. That's 2,000 megawatts, 2 gigawatts. And then you add the Palisades nuclear power, which runs at 93% capacity. So Michigan, guess what they've done now that they're shut down? They have retired the nuclear, and now they're retiring coal. Do you know what they're going to do? They're going to add 350 megawatts of solar, 300 megawatts of wind, and get this 2,500 megawatts of natural gas power, new plants. And Michigan imports 12 times the amount of natural gas that it produces. Its natural gas production has collapsed since the last 15 years, collapsed. So now they're heavily reliant on an energy source of natural gas to run the number one power that powers Michigan's electric grid is natural gas. And they're hoping that they're going to continue to get natural gas. So this is the problem that we're seeing in the world. We're moving from stable power to this highly volatile, just-in-time power. And I hate to tell you, I don't think we're going to have the natural gas supply, growing natural gas supplies to power all these systems in the future. That's another factor the market has overlooked.
So, I just have to say, I don't want to leave it unsaid. The energy return on energy investment of nuclear is somewhere between 60 to 70, based on the figures that we see. And I would not generalize the fact that it is difficult to make a profit operating a nuclear reactor in the American regulatory system with, therefore, nuclear is not going to be a good answer for China, because the way the government treats the production of primary energy in China is vastly different than it is here. And I would agree that it is, given the regulatory quagmire that is the U.S. and the obtuse and often baffling mechanisms by which shareholders are remunerated for taking economic risk, like running an like running a nuclear power plant. It may not make sense for a particular company to keep a particular plant operating, but from a policy perspective, it's just undeniable that the energy return on energy investment and the stability of the energy you get from nuclear, we have to reconfigure the economic motivations and payoffs in our society so that we can have more nuclear and not less.
I'd like to just elaborate on what Steve is saying. And this question actually really gets to the big picture, I think, of what this discussion is really about. And I think anyone listening to this, by the way, is, light years ahead of most of society at this point, because this energy crisis is almost worse, I would say, than the way we're talking about it. From 2009 to current, we had energy surplus because of the shale patch. And so I think the whole world's been hypnotized on abundant and cheap energy, and also 0% interest rates. And so I think we're going to look back to that decade as one of the greatest periods of malinvestment in our history, because we squandered years and years of an energy surplus. And an energy surplus is really what our entire modern civilized industrial complex is built on. Without the energy surplus, our system simply can't function. Without growing supply growth of energy, you have economies that essentially fall. And so back to the whole technology issue, one of the most interesting dynamics that I've sort of seen on this is with Tesla. Tesla's the lowest cost, highest volume, renewable company in the world. And most people think today, well, this is a great time to go buy this renewable technology because, gas prices are so high. And so Bill Gates calls this the green premium. And he even said green premium is the best way to measure how successful renewable technologies, how well they're doing with them. And guess what? It's going horrific. And why? Because it gets back to I won't, get too wonky, and I think a lot of people on here already understand energy return on energy invested. But essentially, the green premium is actually widening like you've never seen before. And believe it or not, Elon Musk is echoing a lot of what you guys are saying, and most people are misinterpreting what he's saying. So it takes about 5 to 7 times the raw material intensity to build an electric vehicle. And this is really interesting because in the last year and a half, just to keep it simple, the entry-level Tesla, if you're looking to get into an electric vehicle, the entry-level Tesla has gone up $11,000 in under a year and a half. That goes against their complete mission of lowering the price. And this is kind of blowing out the thesis that when it comes to renewables, that, Wright's law or Moore's law works. What we're discovering today is Moore's law and Wright's law does not work with renewables. And you're seeing that with what had been one of the most successful companies in the renewable space to date, which was Tesla. And how can we know that for sure? Okay, look at any comparable ICE car, gas-fueled car, anyone over the same last year and a half. The difference is stunning. Like a Toyota Camry base Toyota has gone up less than $500 over the same time frame. Why? Because it takes less raw material intensity to make a gas-fueled car. It doesn't take near the amount of copper, the lithium, the cobalt, the steel. All the inputs that go in to make an electric vehicle are extreme. Okay, and so it's really interesting to think that, like with the increase in the price of Tesla, because they've had to raise prices, that though oil prices have skyrocketed, if you just calculate $5.50 average per gallon of gas over the next, say, 10 years, it's actually cheaper today. It's contrary to it's contrary to what you would just kind of instinctively think, or common sense, what common sense might tell you. But you're actually better off just going and buying some ICE car that gets roughly 30 miles per hour a gallon. You're actually going to save a substantial amount of money, even more so today than like a year or two ago when oil was at $3. And why? Is because the green premium is widening out because the incremental cost, which is showing the scarcity that we have of oil, natural gas, and all the metals and materials that go into these renewable technologies. And so Tesla's not making it work today. For sure, the turbine wind farms have been a huge misallocation of capital. Solar has been a huge misallocation of capital. In fact, we're going about the process of trying to get the clean and abundant energy completely wrong. We should have started with nuclear. The last 15 years had the world instead investing, $2 or $3 trillion in renewables. Had we put that into new technologies like for nuclear, I think we'd be much further along. But instead, Elon Musk has said it's madness, and he said specifically, it's madness. Let me be clear: it's madness to shut down nuclear power plants. While he's an interesting character these days, Bill Gates is completely pro-nuclear. Warren Buffett is completely pro-nuclear. The energy situation, the scarcity of it, has gotten downright, like our spare oil pumping capacity is hitting, such lows that I think that, most people are going on with their routines. Like this is just a cyclical market. Oil is going to go up. There'll be demand destruction. Everything will be fine. We'll pump more. I just totally disagree with this. The oil and the natural resource market is a structural issue. And so I think my overarching point is I think that like paying attention to energy. And a lot of people they turn off as soon as they hear energy, and they turn blue in the face. It is the thing moving the world today. And it's a structural issue, and I'll just leave it at that, versus a cyclical issue, and it's not going to go away. I mean, the Fed can, create a worldwide induced depression, but that doesn't work for anyone. So ultimately, these structural issues will keep showing up through high prices, I think, for a prolonged period of time. And as you see that, you'll see, a massive shift the way asset allocators move their money. But right now, they've been hypnotized for 15 to 20 years of and models that actually are turning out to be blown. The models are blown up in everyone's faces. And so I'll leave it at that.
Thanks, FMT. Anybody have anything to add to that?
Tom, I'd like to just add one more thing and keep this simple. The energy dynamics that I see playing out is that we're going to hit this peak oil. Let's just call it the peak energy return on investment of oil. And then production is going to start to decline because we're not going to have enough new resources to offset these massive declines, especially with the U.S. shale industry that's declining at 48% a year. People don't realize that. Saudi Arabia, they say its decline rate is 4 or 5. We're declining at 10 times that amount. And the U.S. was 80% of global oil growth in the last 12, 13 years. So this is the dynamic that we're facing. The problem when we start going down the oil production curve, and I see cliff-like declines coming, well, then that shuts down more of the global supply chain. Well, then you cannot make as many wind turbines. You can't make as many solar panels. So what's going to happen? As that is happening, at the same time, all this green wind and solar that we brought on is aging. And it's going to start to become less efficient. And then you've got to replace the wind turbine. Well, we're not going to be able to replace that wind turbine because we're not going to have the energy to replace it. So we're adding all this green energy. And at the same time, we're going to be losing fossil fuel oil. And then we're going to see a downturn in green energy as it becomes problematic to maintain it. Now, that's off in the future, but that's a double whammy that's going to hit us in 10 and 15 years and onward. And the market hasn't factored that into the equation. So unfortunately, green energy was not a solution. It just made the situation much worse.
Steve, I was going to ask you, something you said earlier is that I think you said China is going to stop or going to have to stop mining coal. Was that what you were saying?
Well, no. You see, first of all, China produces 8.5, 9 times the amount of coal the United States does and burns it. It's just a massive amount. That runs the entire, they're not. It takes a lot of coal to smelt metals, make steel and everything. So and also to make concrete, it takes a lot of energy. The problem they have run into is a lot of their coal deposits were closely located near their major cities, but these coal deposits have been running out. So they had to move further away, and that's what they've been doing. And we supposedly have 100 years worth of coal at current production levels in the U.S., and we hear 100 times in other places like Australia. Well, the way China is burning through its reserves, it's got 13 years. But that's just one problem. The other problem is when diesel gets into more trouble, diesel production declines. Well, how is China going to continue pumping out 4.5 billion tons of coal a year? It's going to become problematic. And that's why it all comes back to the oil. Oil is number one. Everything else is 2, 3, 4, 5, 6. And that's also another reason why nuclear is not going to work, because we're not going to have the high-tech global supply chain to make these components, because unfortunately, Captain Kirk doesn't make nuclear components in a Star Trek replicator. They're made the old-fashioned way in this very complex, interwoven global supply chain. The parts are made all over the world. And so this is an issue. We can't go more nuclear. We can't go more high-tech because we've run out the clock.
the energy return on energy invested for nuclear is 6 weeks. I mean, I just think that we can agree to disagree on that. It's not that complicated. There are hundreds of reactors around the world. This is pretty well known. And when you have an irresistible energy return on energy investment like that, it is literally the only solution that gets you out of the energy quagmire. And to say that we can't, I just have to disagree with you.
Well, let me. I mentioned this last time, but I had the wonderful ability to talk for 5 hours. I met the Don Arabian. He was one of the 4 men credited to put a man on the moon, and he was in charge of the mission evaluation room in Houston, Texas. People thought, the space, in Cape Canaveral, that's where the brains were. No, the brains were in Houston, Texas. All the engineers were there. They were there to try to figure out all the problems with the Apollo program. And Don Arabian was the head of the mission evaluation room. He retired, was in Cape Canaveral when I used to live in Florida. And I actually met him. And he told me, he said, Steve, we took the energy of the sun, highly radioactive, and we put that bastard in our backyard. So we have done a pretty good job trying to control it, but most of these reactors have not been decommissioned, right? They're still running. We've seen some problems. We have Fukushima, we've had Chernobyl. The issue is, if you think mankind is stupid as a politician, wait till what happens when we don't have the energy to continue running these nuclear power plants? To maintain to continue getting the uranium, to continue, putting new fuel. So I think my thing is, I do get, you shouldn't be shutting down more nuclear baseload. I get that. Okay, that's easy to understand. But I think the problems we're going to be facing with nuclear power when we go over this energy cliff, I think it's a big question mark, and it can be Fukushima on steroids. And that's what I am very concerned about.
So, Steve, as you're talking about, let's say, not having enough energy, for example, to get more uranium, the reason I asked the question about if we're not able to keep continuing, or let's say China, for example, isn't able to keep continuing to mine enough coal or let's say the energy that they have to invest, because the cost of diesel becomes so high that it becomes basically unprofitable to keep digging out more coal. How do you think that starts to affect the metals? Is the return on the energy investment so great by mining gold and silver, or so much greater than coal? Does that offset that equation?
And Tom, you're talking about the value of the metals. Is that what you're getting at?
Well, I'm just thinking about mining in general, and considering that it's so energy intensive, we need a lot of diesel to be able to do it, regardless of what the actual, let's say, product that we're digging out of the ground is. Does the energy, or let's say the profit offset of the energy invested for the metals, does that equation work so much better for gold and silver, let's just say, for example, than it does for coal?
Yes, and to answer your question, I try to keep things really simple. We have to go back in history. The reason why the Roman Empire peaked is they ran out of good quality, high energy return on investment wood. When they ran out of this high energy return on investment wood to make charcoal, they also peaked in silver production. And they also peaked in copper and gold production, lead production. So when they can no longer continue to increase their silver supply, guess what happened? They had to start devaluing their denarius. So there's no coincidence that the peak of the Roman Empire occurred due to the peak of their wood fuel. Well, we're facing the same dynamic now. However, it's fossil fuels. It's oil, natural gas, and coal, and nuclear down, and then everything else is third, fourth, fifth, sixth fiddle. So the issue is, if you look at a graph and you graph oil production increase, you'll see that copper, gold, silver, all the metals, aluminum, they all go up exponentially with oil. And guess what? They all are going to come down in the same fashion when oil production declines. And so when oil production declines, we're going to have less metal production. We're going to have less coal production. We're going to have less natural gas production. And we're going to have lesser of an ability to allow nuclear energy to work. And that's where I'm a little bit different. I think there's a lot of big problems coming with nuclear in the future, because as the systems start to break down, right? When you have less energy, like you're seeing in different parts of the world, 57 countries are in severe trouble of collapse due to food, due to debt, and due to currency. Well, when this starts to thunder throughout the entire economy, and in the Western countries, what happens when you can't maintain these nuclear power plants? I'm not saying it's going to happen, but this is a problem that no one is addressing. And I'd rather shut down a coal plant because we don't have enough coal. I'd rather shut down a natural gas plant because we don't have enough natural gas. But to try to decommission properly a nuclear power plant, and you don't have the money or the energy to do it, I think that's a big can of worms the world has not yet factored in.
The world doesn't need to factor it in because it's not, I'm going to hold back a little bit. We are swimming in uranium. We have so much uranium that we had to create a financial instrument to gobble up excess inventory in order to try to get prices off the mat so that we could motivate uranium miners to create new supply. The price of uranium is 70% below its all-time high. And in a world where energy is constrained, you are not going to prioritize away from nuclear power, which has a 60 to 70 energy return on energy investment. You're going to deprioritize silly things like wind. And so there is no, in the scenario where we don't have enough energy to maintain and grow nuclear energy, we got bigger problems than the age of the nuclear fleet. I mean, it's just, we can agree to disagree, but it's just to say that the price of diesel is going to impact the supply of uranium, and that somehow this is going to limit our capacity to expand nuclear is just not correct.
I will agree to disagree with you. And the best way to do this then, Doomberg, is let's just see how things play out. Because I don't want to be right. I'd rather nuclear be fine and continue to work for us. But from the analysis that I'm looking at, I think we're going to have serious problems with nuclear in the future. But I would be happy to say you were right.
So, guys, you know, when we think about, let's say, the political attitude or the public's attitude towards more traditional forms of energy, whether it be fossil fuel, nuclear, excluding, let's say, wind and solar, do you think that the pain and suffering of not having enough energy is going to take care of the attitude towards going back on some of these ESG mandates and you know, hopefully trying to reverse some of this, some of these short-sighted policies that we have moved towards without them really being ready to replace the energy that we're trying to get rid of?
We're seeing that today in Germany. I mean, they're going back to coal. You're seeing it in India, where they're circumventing the sanctions to get as much cheap Russian oil as they can. We're seeing this bifurcation in the world, you know, Saudi Arabia, China, India, Russia, Brazil, versus the Western world that is still living in this fantasy that we can have an energy deficit and still have strong currencies and robust economies. And so, yeah, I just think given the choice between starving today or dealing with the consequences of environmental impacts decades down the road, the people, either directly or indirectly, will choose to take the chance and roll the dice on the future, because you can't worry about the future if you don't make it there. And in the absence of a reintroduction to the physics of energy, there's going to be a lot of people starving.
Also, Tom, we haven't had a full cycle of electric cars yet. Teslas are still so new, and Chevrolet Volts, the Chevrolet Bolt, I guess it's called. They're still so new that they haven't run out of battery yet. When the batteries run out, let's say after 10 years or 12 years or something like that, the batteries are not recyclable. All right, so then you've got a dead Tesla or you got a dead Chevrolet Bolt, You call the dealership and the Tesla guy says it's going to be 40,000 or 35,000, or it might be 50,000 with inflation to replace that battery, but the car is worth zero without the battery. So all of a sudden you're going to say, I'm going to put $50,000 in my Tesla, or am I going to go buy a new Tesla that they might be 150 by then? So we haven't had that cycle yet, but it's coming. But in answer to one of your questions, I think, Tom, I think that a change in leadership from the ESG pro-Democrats that we've got now in the United States of America to somebody with a little more common sense. We can't change it from internal combustion fully to electric by the year 2030 or 2032, what they're trying to do. Now, still there'd be internal combustion engine cars still on the road, but imagine if you've been to California and you drive from Laguna Beach to Los Angeles or something, any day of the week, anytime, the freeways are full. All right? Well, stop and ask yourself a question. If I'm a renter in Los Angeles, California, where am I going to charge my car? You go home to an apartment and the apartment has 200 cars in the lot. There's not one charger there. The landlord isn't going to put in 200 chargers for his tenants. All right. So everybody that has a home garage, they can put a charging station in their garage, but not everybody owns a home in California. Not everybody owns a home in America. There's a lot of renters. So I don't think that the liberals have thought this through when they put a deadline of 2030, 2032, 2035. It's not that long. It's not that far in the future right now.
Yeah, it seems to me that the world thinks we have a light switch and we can just turn off the fossil fuels, coal, oil, natural gas, just turn them off, stop producing them, and switch over to electricity, everything.
100% agree.
Renewable everything. And that's just not possible. And so I echo what Doomberg was saying, that, especially in the United States, we have this perverse ability to get to the edge of the cliff before we start to solve some issues. And so I do think public perception will shift, especially with ESG mandates and extreme hostility towards fossil fuels. It's going to have to. I mean, to me, it's going to be a game of uncle. It's like, the energy crisis, as this continues and the structural problems continue to rear their ugly head, I believe that people will start to understand that this is just not a problem that's just going to disappear anytime soon. And a big part, you guys were talking earlier about is this sort of manufactured or is this natural? And I think it's based on ignorance, a lot of huge public misconceptions about where we are with renewables, and more so political pressure. I mean, if you're Biden, you're in the back pocket of ESG. You're in the back pocket of Bill Gates. These people are your big primary sources of donations. And so you can see the pressure coming out today. The current administration, to me, they're in deep waters. They're drowning and they're flailing away with their hands, trying to get their nose in the air, just trying to breathe. And what are they doing? They're blaming Russia, Ukraine for this crisis. They're blaming, greedy fossil fuel producers, gas and oil companies. In fact, just yesterday, I believe, the economic advisor to Biden was saying they haven't ruled out windfall tax profits on the oil and gas sector. The oil and gas sector, you have executives that are, have been around for 30, 40, 50 years. They have been completely disincentivized, assuming that, let's say Steve's wrong and there is a ton of oil out there to be produced. It doesn't matter. They don't want to go get it because of the hostility. And the other thing is with the hostility, they're only going to tier one drill. That's all they're doing. They're going after the cheap and easy production to keep their profits high, to keep the shareholders happy, and people, this rare recency bias of it's been a terrible sector to be invested in, and that's most of what Wall Street has a problem. The money has not moved into energy yet. It has not moved into gold, silver. It has not really moved into commodities, but I believe it's coming as the public perception shifts that what we need. Look. it's amazing how many like famous, I won't name names, tech analysts have been so wildly wrong. You know, one saying, you know, she thinks we hit peak demand in 1999. We're going to hit record consumption of coal, natural gas, and oil. It just keeps relentlessly marching higher. And renewables, we do not have a viable renewable alternative to bridge the gap for decades, probably, right? And so the answer is not restrict production, have a hostile viewpoint against the sector. It's even assuming we have plenty of oil out there, which it doesn't look like we have. We haven't made a good find for over 20 years. The Shell was an absolute gorgeous find, but we've wasted that energy surplus with things that are not working today. And so I would say that yeah, for sure. The public perception is going to shift, but it's going to be a hard, long road because the ESG mandates and the ignorance, and I think that's why like a talk like this is so important. The more people realize this true structural problem in the energy markets, it's the you know, our pockets are empty with these natural resources, with all natural resources. I mean, you know, silver. We're eating into scrap supplies at this point, as you guys are all well aware. Copper shortage, right? Oil shortage, capacity is drying. Natural gas, you name it, right? It's we're going to look at the next decade as the last decade as a malinvestment, the greatest malinvestment decade in history. But we probably will look at the next decade as a shortage of everything decade, where we're just short everything. And so, like, we have to be very careful about how we spend our real currency, which is energy. Very, very careful, and because it's such a divisive topic. I think it's going to be a very, very difficult road, but I think ultimately public perception will shift. I just hope that it's, you know, in time or on time enough where, you know, it can save our bacon.
How do you guys think, and I'd like to get whoever wants to chime in on this, how do you guys think about, you know, the incentive structure for, obviously energy companies need higher prices and to not be threatened by these ESG mandates and the political elite that want to get rid of them or tax them into oblivion. But how do we incentivize proper energy policy from a governmental standpoint going forward?
I think leadership is a big part of that, Tom. In the United States, we've had leadership in the last 2 years, or since, you know, the liberals took over. They are very interested, as has been said, in driving a thorn through the heart of fossil fuels. If the leadership changes, we could maybe start that this coming November, that they would take effect in January of 2023. That would be a good point, or a good, road to drive on, so to speak, where I think the windfall profit tax would go away, and it would be such that let the corporations, you know, do their thing. Let them explore and produce and give supply for the demand that we've got. But if the leadership that we've got, the current leadership in the United States, if they get stronger, heaven forbid, I think that is a big headwind towards energy.
Doomberg, anything to add there, or Steve?
All right, I'll quickly. I think the issue is this: we need to look back where we came from. And in 2008, 2009 financial crisis, things looked pretty bad, especially in the United States. And you know what happens in the United States affects China and the rest of the world. So we saw the markets crash. We saw the oil price crash. We saw all these problems. And then out of that came the shale industry. And that was the savior. That really was the savior. And then we have to also include oil sands. So if you look at the rest of the world, oil production minus the US and Canada, from 97 to 2008, they added 12 million barrels a day of production. US and Canada lost a little bit. Now from 2008 to 2019, it totally flipped. The U.S. and Canada added 12 million barrels of production. The rest of the world lost a little bit. So if we're looking for the rest of the world to come to the savior, it's not. Unfortunately, yeah, there's still oil out there. But I mentioned this many times. When you're running a car at 25 miles an hour, you can do that for a long period. It's designed to run at 55, 60. You run that car at 100 miles an hour down a highway, and you keep doing that for a long period of time, that car is going to break down quick, and the tires are going to blow out. Well, when you're running a world at 100 million barrels of oil production a day, that's what we were in 2019 before the pandemic. It's hard to run an economy at such a high rate because you have to continue to replace this production that's declining every year. And now it's becoming impossible to do that. So the way I look at it, Tom, the way I differ from many people is that the debt on these major oil companies' balance sheet was about 65 billion on the major ones back in 2012. It's now quadrupled to 240 billion. So that debt was used to bring on more production, to keep things going. But there you go. Perfect example, all this debt. And now a lot of that debt's not going to be repaid. And so that just shows you we're using debt to continue the falling energy return on investment. And so now, as we head over the energy cliff, the problem is the debt. All the debt now that we're trying to add, you can only do that when you're increasing energy, because that kind of allows it to work. And then, of course, the interest on that debt can be serviceable. Well, when now interest rates rising and energy reduction we can't get back up to where we were and it starts declining, the whole debt bubble just implodes. And when the debt bubble implodes, then pensioners, their check they get is going to implode. 401ks are going to implode. So what happens? The money to spend in the economy implodes. And what does that do? Oil production implodes. And that's the cliff-like declines that are coming. So it's not that the amount of barrels that are out there, we counting barrels. How many barrels do we have left? No, it's the quality and the energy return on investment of the barrels that have been propped up by the debt. And so this is a major factor that I believe within the next 8 to 15 years is going to change the world drastically as we know it. And so I think that's why I've got a much different outlook of the world than those that believe we can kind of fill in the blanks with this source or this energy source. I think we've run out the clock. I think it's going to get very problematic in the next 8 years and onward.
Not to diminish the debts, the energy side of this conversation, that's been very lengthy, and I agree with most of it. But my feeling of these timeframes that are being released is you're going to be dying of something a lot sooner that's not related to energy, despite energy costs remaining stubbornly high and going higher. And that is the debt and FX markets. These are the new crypto markets, as I keep telling all my listeners. You are seeing minor differences at central bank policy levels, seeing huge structural release valves taking place in the FX markets, such as the yen, as we've described. This is a major currency. You've got to understand that the Euro USD is the biggest. The USD yen is probably the most significant other currency. People don't talk about it often. This is just one country exercising yield control because they have 279% of debt to GDP. And as a result, they've got all their pensioners invested in locally, domestically, and domestic debt. They're all going on to pension. They have a demographic problem. All the pensioners are sitting on very little youth, very low birth rates, careers even worse. Long before we see the full play out of the energy discussion that's been going on. And as I already say, I absolutely agree on nuclear and most of what's said here. You will have gone through a birthing event, a death and a birthing event. And this is going to be, this is what the debt markets are indicating. So when people are talking 5 to 10, 15 years, I'm saying, well, we've all probably been shot in the head by then, in terms of what's happening structurally on currency markets, on debt markets. And this plays far more closely to to what Palisades Radio, the host of the show, is all about, which is the gold and silver markets. And what do you hold to transition through not the end of a 40-year bond cycle, but the end of a double cycle at least? This is a systemic full-scale failure. Not only is the debt never payable, the interest rate policies cannot return to anything moderately normal. And the collapse of the debt markets right now are pushing yields up. This is the time ticking bomb. We can talk about all the other places where, we're going to run out of energy, we're going to run out of this. It's almost, I felt throughout this conversation, the elephant in the room that is immediate is what's happening right now, even an example of what went on today. Not because we're geniuses, but because we are of the view that they will continue to understate their expectations on inflation and the actual number will overshoot. We were long dollar. We were short crypto. We thought the oil would have probably an inflection down and wind up before more continuation. It puts you in the right seat on most market moves when you understand that they're going to be overs on the sentiment of the consumer, not always pretending that they should be in better shape. I've just seen tweets about Yellen saying everyone should feel much better and they've never had it so good type things. And they're going to be absolutely unders on the real inflationary fact. Part of that has to do with the energies of the oil markets remaining stubbornly high. But what that means is that they're going to continually be under a hyper stagflationary. This is our term. It's not normal stagflation like the 70s, as bitter as that was. It's far, far worse. You cannot, there is no interest rate policy that can deal with the extent of inflation and at the same time not murder the economy. To have a sufficient amount of stimulus so that this economy doesn't die, you would need exceedingly low rates, which we've had for an extended period at a hyper stimulus level. And to kill inflation, we should be excessively above where we are today, not moderately, excessively. The last time Germany had the inflation rates that it's had was 40 years ago, and they're at something like 12%. Quote me, it might have been 11%. So we are so far behind the curve on restraining inflation. And the only reason is it's debt related. And the slight difference in moderate, we've only done a small amount of tightening. Yes, the yields have moved on the American debt, but the slight difference in what America has done relative to probably a shadow stats that must be now approaching 20% and a declared essentially year on year with a 1% this month being almost 12%. Now that obviously assumes similar rates, but you're clearly even on the BLS stats at 8+++. We are so far behind actually curtailing it, and you kill a monster when it's small. When you're talking about inflation, this monster is already a teenager, my friend. He's already picking his nose and slapping your backside. That you are going to get beaten the hell up on the debt collapse. We are watching a debt system that is going to collapse, and it doesn't need the rates of Volcker. It would die long before. The sensitivity of the system due to the scale of the debt is so much larger. Yes, it's been brought about by energy, all sorts of non-productive fracking, but debt is the story and gold is the answer. And the FX market moves that you're seeing right now are the release valves, and you're having 7 sigma moves on currencies that have been stably within very tight ranges for the last 10 years. We are watching reset. Everybody asks, when is reset? You are watching it happen right now. A debt system is dying, and it won't go to 20% to die. It'll have died long before. And that's my great message. I think all these problems that we're discussing on nuclear and energy are huge and are relevant, and they will need to be tackled as well, and they will have to be volatile. We're going to be living in a different world by the time that is. We'll probably be on central bank digital tokens and all sorts of other things. And this is the immediacy problem. And I'm waking up with a gun in my face, and I want to deal with that issue, not how I'm getting to work in an hour and a half's time. And that's the focus I would suggest. People should own physical metal and silver and gold. They should have it on their own under their own control. They should stand by and watch and expect this debt explosion and the halvening of the global supply chain with this Russia-China split divide is only further going to accelerate inflation and further accelerate the need for interest rate hikes, which will further accelerate the debt collapse. You are watching something falling over, and it's happening right in front of you. It's the gun in your face right now. That's my core message.
I would tend to agree with a lot of that. I would just give a little pushback on one thing. Certainly, the monetary authorities, the central banks, and plus the fiscal policy with our government, they clearly created way too much currency, and the money supply grew 40% in less than 2 years, which is absolutely astronomical. But I would still sort of revert back to what Steve is saying with energy. I still think energy is literally the dog wagging the tail here. It's not the central planners. The energy is actually in charge of the debt markets. It's in charge of our economies. We're not in charge. Nature's in charge, and we're handling it really poorly. And here's where my pushback is I would agree the Fed should have never been here in the first place. We never should have kept interest rates below the real rate of inflation for almost 2 decades. Huge mistake. But they've already made it. And so now I believe they're making another mistake. I actually, unlike a completely contrarian viewpoint, because I do believe energy is the thing that is dictating the globe today.
Then explain the dot-com boom, and then explain the great financial housing crisis. Those things have very little to do with the price of oil, natural gas, and everything else. Debt was created and extended and occurred as a result of those events.
No, I don't disagree with that part. That was in 2008. That was in 2000. Today we're in 2002. My point is the pushback with the interest rate and how they're way behind the curve. Of course, they're behind the curve, but at this point, because it's energy markets that is moving inflation, it's not a coincidence that if you pull up a 5-year, 10-year, 20-year chart of the price of crude and say the 10-year treasury, which is probably the best benchmark overall for interest rates, if you pull up a chart of those, the correlation between energy prices and the 10-year yield is almost 1-to-1. I mean, they move almost exactly together over a long period of time. Why? Because it's energy that's driving inflation overall. And interest rates, despite the fact when the Fed is suppressing interest rates by buying bonds, again, distorting what the real rate of interest should be. But when they're not doing that, what you're starting to see right now in the markets is a true market signal, right? You're starting to see, even on a day like this, interest rates aren't getting a bid. Why? Because the problem is inflation, the problem is energy. And so while the markets are blowing up today, so is the bond market. And why is the bond market blowing up? It's because of the energy problems. And so the pushback I'd have it's a completely contrarian viewpoint, and I'll give you that. And they are behind the curve, but they should have never got here. So now, by jacking up interest rates from here and to keep jacking them up, that doesn't fix the inflation problem. The Fed's not in charge of the completely restrictive policies in the energy markets. I mean, the Fed can't change the supply of oil and natural gas and coal coming onto the market. The Fed has nothing to do with that. And even more scarily, I don't think they really understand the energy markets. Definitely Janet Yellen doesn't. Just yesterday, she was saying we need to move away from oil and natural gas, and that will lower interest rates. Or that'll help fix inflation. Actually, we need to lean into oil and gas. We need to loosen up on these restrictive policies. If you look at the sheer hostility they're under, it's extreme. I mean, just we're producing 1 million barrels per day less in refining capacity because of the shutdowns of the refiners. No refiner wants to build a plant, put in billions of dollars when everyone's telling them, like, look, we don't want to use fossil fuels anymore. We want to basically, wean ourselves off, get off of fossil fuels, and bankrupt the industry. Again, it's not a light switch. We need decades to move off of fossil fuels, and I don't think we ever really truly can. We'll use carbon capture. And so my point to this on the whole, the Fed is way behind the curve today. They should have never been here. That's for sure. But now, by increasing interest rates, they're going to just prolong the high inflationary inputs. They might be able to slow it down by creating a massive asset crash. But what happens to the drillers? What happens to the producers if oil goes back down to 50, 60, 45? We saw that those prices don't work for them. They don't earn their cost of capital, especially if interest rates are higher. And so we're in this massive asset crash. The government debts go from 31 trillion to 40 trillion because, they're taking in peak revenues and taxes right now. They're taking in 4 trillion. So when the economy blows up, their tax base will blow up, and the federal government, with mandated spending at about 60% of all their expenditures, will skyrocket, right? And so what will happen? The Fed will have to backtrack. They might even have to go back to lowering rates and printing more money again. What's going to happen to the energy markets in that? When the economy looks like it's coming back around and everyone thinks it's looking good again, you can't just turn on a well and just start pumping again that easily. Look what's going on now in the best wells in the Permian and other parts of the country. They can't get labor. They can't get equipment. They can't get sand. They can't get all the things they need to get the peak pumping capacity with their proven reserves. And why? Because of the shutdowns, the supply chain problems, the problem they're having. That will only get worse if the Fed keeps tightening and chokes off the economy to the point that we have a major asset crash. And so when they have to reverse, if they go that route, the inflation is just going to rear its ugly head back even faster and even worse. And so by raising interest rates, it's not going to fix the structural inflation problem until we fix the structural energy problem. So, and I do hope Steve's wrong is on that, and I hope that we can fix the structural energy problem. But again, the road's looking tough, and by raising interest rates in here, it's not going to fix the inflation problem. So I would put pushback on that. We're not going to fix inflation by raising interest rate at any level at this point, because it'll just crash the economy, which will crash the energy markets, which means.
I think it's important to understand that bond prices are going down, or interest rates are rising because the Fed's removing or liquidity is being removed from the system. Oil is just interest rates aren't really reacting to oil; they're reacting to liquidity, and it's because of all the money printing and so forth the last few years that's given room for energy to kind of blossom here. But the Fed's idea is that they could try to create some demand destruction to try and remove that wealth effect and sort of the pressure from the demand side, which obviously is not going to fix the supply side. But and their ingenious thoughts that they think they can try and reduce inflation by a controlled demolition of financial markets.
The inflation and the proliferation and the total of debt is not purely a function of fossil fuels. I found that an absolute simplification and hopelessly inaccurate. We are over indebted because we proliferated too much debt and created too much money. And that money has gone in many directions: transgender rights, BLM, all sorts of quangos, all sorts of things, none of which have anything to do with energy. The notion that a 10-year yield in the energy market is the same and therefore bond rates are tied to fossil fuels, I reject entirely. We are here because of a central banking cartel that has proliferated in money for all forms of reasons, beyond and including energy, social purposes, all variety of wars, which obviously have an oil element in it. It also has a military industrial complex in it. There are many, many different reasons that they have sold us for getting it. Not to increase rates would absolutely see a runaway hyperinflation. And I'm surprised the sympathy for that as a policy. You absolutely have to crash. Inflation starts in the asset classes. You had hyperinflation, hyper-evaluation. Let me tell you, after this current correction on the S&P, you are still, relative to GDP, higher than you were in the peak of the great financial crisis in terms of valuation of stocks. Inflation, everybody thinks inflation is CPI and the cost of your bread and milk. Asset inflation always comes first, because the people getting the cheap money are the billionaire class that don't worry about the bread price and the milk price. They've got all the bread and milk they need, and they are investors and they are buying up assets. And assets are the first runaway. We have been inflating through the Goldilocks period while you was bragging about no inflation, and it was a Goldilocks period. What we inflated was hypervaluations. First in equities in the technology boom, later after that crashed into property in a property boom. This is inflation. It's asset price inflation. It's the first core foundry. Then the prices on commoditized goods fall. We are in a late stage inflationary cycle while everyone's been going, where's the inflation? It has all been as a result of printing money. It has not been all as a result of oil or fossil fuels. This is flagrant abuse by a central bank coordinated cartel. There's no place you can go that isn't in the same situation. This is why I consider it synchronized to a high level. There's no one who said, hey, hang on, why don't we follow sound money principles like Hayek? Why don't we not do it? It was also, you had to kiss the leprosy girl to all become part of the team. And that is how we are in. And I have to disagree. We can also take the energy element to this to an umpteenth degree. We haven't needed fossil fuels to be irresponsible financially. We found every possible reason to be irresponsible financially over a sustained period. And we are in the post-asset hyperinflation period that is now needed to be utterly crashed. And there's going to be forced sellers at the bottom who are going to be left bankrupt or very, very poor. The rate hikes are an absolute essential, even though they will not make anyone feel good. It's an absolute pain. And it's because we've had multi-decades of no-pain economy that we now have to take a huge hit. If we had taken our recessions, if we let the great financial crisis run without quantitative easing, if we had not stepped in with 7 trillion in funds, so many other things might have broken, sure. But the key is the minute you take a no-pain economy approach, as we did post-Greenspan, we have been in a no-pain Fed policy where every time the people that are creating the problems, that are burning your house down, have to be the fire engine that shows up to put the fire out. And that is in essence where we are. This is the end of a macro cycle of debt.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.